All right. So, well, I got Nick, the CPA, on the call today, guys. So, he's a CPA that is on TikTok. I found him through TikTok, and he's kind of the guy that I tag in all my comments to like watch my video and like validate everything that I'm saying so that these TikTok trolls actually like believe what I'm saying. And what I'm saying is actually, backed up with some actual tax professionals. Obviously, I am not a tax professional. So today is the day to ask a tax strategist as many questions as I have. And hopefully some of the questions I ask Nick here will also resonate with some of you guys, because like I said, I am a W-2, high W-2 income earner. And so a lot of these tax strategies that we're going to be talking about are specifically for high W-2 income earners who are paying a lot of money in taxes, income tax, and kind of help you kind of save money on taxes so that you can go reinvest those tax savings, right? Because that's, again, my general strategy. So yeah, welcome, Nick. And maybe you can just start off by telling us a little bit about yourself, kind of what is a CPA versus like a tax strategist, perhaps, and like how do you kind of help people?
Yeah, so I mean, the main differences people would look at. So, what is a CPA? A CPA is just someone who got a licensure having to deal with broad spectrum accounting, right? And then as a CPA, you can define yourself, you can niche into auditing, either, like being a CFO, kind of managerial accounting, things like that, tax preparation. A lot of the times when people think of a CPA, they think of a tax preparer, which is fair. A lot of us do go into tax preparation or audit. Those are the general paths most people take. That's how people relate. They're like, oh, I have a CPA, even if they just have a tax accountant. Having a CPA does allow more breadth of knowledge in things, but ultimately allows us to be able to represent our clients before the IRS and to do more things, more audit and things like that are just kind of available to us. Otherwise, I've chosen to go into tax prep. And so that's where I've focused my energy. That's where I've focused my general knowledge gathering. So that's where I've put in my expertise. Much like you would think of an EA is tax specific. I'm a CPA with tax specific education. So that's the world that I live in. So in terms of like tax strategist, not tax strategist, it just depends on the accountant. Depends on what your accountant's doing for you. So some either are just going to do tax preparation and maybe some consultation, but generally speaking, you're going to see them one time a year, and that's kind of it. Maybe they do some bookkeeping or something like that. Tax strategist would be that next level where it's like, hey, I need someone where you're not only looking at the historical aspect of my taxes, looking at last year, you're also helping me plan for the future, and you're helping me figure out other ways that I can
Right.
either put my money into something, how it affects me tax wise, either reducing my taxes or
Yeah.
finding a good long term strategy. So I mean, those are kind of the differences between all of it.
And so, yeah, the thing, and to be clear, Nick is not my CPA. He's just a CPA who is on social media that happens to reply to a lot of my comments and videos and kind of helps me understand the tax code a little bit better. So, but if you want to work with Nick, the link to his firm will be down in the description below, or you can go to his TikTok or YouTube at Nick the CPA. The main thing that I really want to for W-2 employees to understand is that most W-2 high W-2 income earners, they need tax strategy more than they need tax prep. I don't know if
Mm-hmm.
you think that's true or not, because tax prep, like you said, is more of a proactive approach. It's more like this happens at the beginning of the year, right? Where it's like, okay, you have $200,000. How can we plan to spend this money to buy assets that are going to help us pay less taxes for this calendar year? Whereas tax prep happens more like after the year is already over. There's not really much you can do anymore because, in order to save money on taxes, you need to be going out and spending money on these assets that help you pay less taxes. But then the year's already over. You don't really have much time to do that. So tax strategy or working with a tax strategist kind of helps you define what you should be buying and why you should be buying it, and the tax implications or the tax savings that you could get from buying those things. So hopefully that clears up the difference between tax strategy, tax prep. With that, should every W-2 employee have a tax strategist?
No, never is anything universal. So
Right.
if you have $50,000 and you're barely making ends meet, the last thing that you need is maybe even someone to do your tax preparation for you. You need to work on making more money. If you have a high, if you have a high W-2, it could be something that you
Yeah.
need. Ultimately, it depends on what one's goals are. Because honestly, if you have a high W-2, but you actually don't have disposable income, which does happen,
Well, let me stop you right there. When you say high W-2 income, what do you kind of consider high? Because for me, I've kind of been defining it as like anything past the 32% bracket and higher. But that's just my definition. What would you kind of consider?
Yeah, sure. And anything, what, probably above like 400,000 or so would be a high W-2, if anything.
Right. Yeah. And for the most part, you can only save as much taxes as you are going to owe, right? So if you were making $100,000, you were only going to owe $15,000 in taxes that year. That's like the most that you could potentially save in taxes. Whereas if you're
Mhm.
making $500,000 a year and your tax bill was going to be $100,000, well, we can implement some strategies to help you pay less of that $100,000. But if you're not making good income, if you don't really have a big tax bill, then I guess you could say the effects of these strategies that we're going to talk about are kind of not as great because you don't really have a big tax bill to begin with.
Yeah. Ultimately, I'm just saying in terms of should every W-2 person have a someone to do tax strategy with? No. Not even everyone who has maybe a high W-2, because maybe that is not what their goal is. Maybe their goal is not
Sure.
to invest into real estate. Maybe they have a really high goal of investing in the market and doing things that way. Where there's no, they need a broker. They need an investment broker to help them with
Right.
those things. So it depends on everyone's goals at the end of the day. It also is important to understand that not every single strategy you may employ is a tax deductible strategy. There might be strategies you're employing to earn more money to build your wealth so that at the end of a certain end period of time, you're minimizing your taxes all along. You're making sure that you're paying only what you need to pay. But ultimately, you're building your wealth so eventually you can get out of this earned income world and move into a passive income world, a world where you're living off your investments rather than living off your W-2 wage. It's also helpful to understand that there's a time in your life you're going to pay taxes. If your whole goal is to live like Robert Kiyosaki, you're not going to be Robert Kiyosaki tomorrow. You're not going to have years of no taxes or very high taxes or all over the place because it took him a long time to build up the wealth that he has. There's a difference between wealth and cash, obviously. To build up wealth means I need to have a lot of assets. I need to build up my portfolio of assets, whether that be investing in other businesses, whether that be investing in real estate or investing some of it in the market, right? You're going to have a diversification of your investments. It takes time and it takes money. So I need to earn money to be able to spend money
Right.
on investments and things like that that
Yeah.
are eventually going to lead me to not needing to earn those dollars anymore. I'm going to reduce, as soon as I can stop earning those dollars and start having it passively come into me, that means I don't have FICA tax. It's the first thing that's going to go away. I don't have to worry about that anymore. Now, a lot of my passive losses that come from these other investments I have are going to benefit me against my passive income, right? So there
Yeah.
are definitely certain things that come in time. So my
Yeah.
first thing I always tell people is if your entire goal is to pay no taxes, you can be poor. This is always an option. You can just go make no money. You can pay no taxes. It's fine. But
It's always better to make more money and pay more taxes than to make less money and pay less taxes, right?
people, I think one of the biggest things that people have a hard time understanding is like, but I'm going to move up into another tax bracket. Yes, but you're still going to make more money than the taxes you're going to pay. You will have more dollars in your pocket to then invest into something that can help you. Certain years, you might be able to reduce your taxes. But ultimately, if you want to be able to
Right.
invest in things, you're going to have to show income. Obviously, if you have a lot of
Right.
depreciation losses, if you have a good lender, they'll be able to add those things back and help you with the investment in other things. And if you're buying investable assets like real estate, they're going to base it
Yeah.
on also the income that thing generates for you
Yeah.
beyond
And
just
so
your income.
you mentioned something really, really key that a lot of people don't get right, which is for me last year, I was able to use real estate professional status and use about $400,000 of passive losses from my real estate business to offset my entire $400,000 income. So most people would look at that and be like, well, that means you reported $0 on your for taxable income that year. How the hell do you get a loan? Well, about $400,000 of those losses were due to bonus depreciation. And you just mentioned some lenders will actually add back bonus depreciation and then calculate your income. So if you
Mhm.
add back bonus depreciation, my income is still $400,000. It can still qualify for loans. Is that correct?
Yeah, it's true. It depends. You need to have a good lender who understands business and understands those things. But I'm in the real estate field. I have my real estate broker's license as well. So
Right.
I come from that background. I work with a number of lenders. There's some that they don't understand. Their underwriters
Right.
mark it off and they don't know what to do. Some lenders
Gotcha.
do understand. So you want to make sure you have a good lender and a good real estate agent to be able to help you with that kind of stuff.
Gotcha. Okay. Well, let's move on a little bit. And the main thing I wanted to kind of focus on is because a lot of people don't really know what it looks like to work with a CPA, like the day-to-day interaction. Like, can you kind of show us a little bit about like what it actually looks like working with you? Like let's say I just signed up. What kind of happens? Like, how do I really work with you? What's our interaction like? Is it mostly emails? Are we doing video calls? Like, how often? Maybe you can give us a little insight into what it looks like to actually work with you.
So, I mean, it all comes back to whatever one's needs are. So, if someone's like, hey, I really would like to have monthly meetings to go over the things that I have going on in my investment strategies or something like that, most people don't need that because most of the time you don't have things going on every month unless you're a business and you have maybe books to review and things like that. But let's say someone who has a high W-2 that's looking to get an investment and things like that into real estate. In your case, you're probably looking at, you're going to need some time of mine throughout the year as you're looking to invest in these properties. You're going to want to know the tax impact of buying this. You're going to want to know what kind of cost segregation possibilities might there be with this. How is this going to reduce my taxes? What can I do to make sure that I'm putting myself in a position to be a real estate professional, whatever it might be, right? The way that I interact with my clients is, let's say there's someone in that situation. One, please email me. Like, you can always email me. That's a part of our value beyond just doing a tax return, is because we're a tax prep firm first, but it's, hey, send me an email. I want to be able to help you during the year because I can't help you. Like you mentioned before, once January 1 hits, the year's over. We can't do anything retroactively, especially with the situation of a W-2 earner. There's very little retroactive things that you can do, if any. Let's make sure we talk during the year. As you see something come up, let me know. I want to be able to help you at that time. Then as we move into like, okay, I'm looking to get into this property. Can we do an analysis on this? Can you let me know what the income and expenses or what things I should be keeping track of during the year? Those are going to be like paid consultations, things like that. But generally speaking, just interact with me during the year. I'm not an attorney. I'm not going to send my clients a bill every time I get an email from them. I want to be able to talk with them during the year. But again, it all comes back to whatever their needs are. Some people, they don't want to talk to you until something occurs. So it's just as needed. Some people want to have it more fixed. Like, hey, every quarter, can we talk about things so I can update you on what's going on? That's fantastic. The more communication I have with the client, the better I can help them. That's why we do have a tax, in terms of tax strategy, like we do have a tax advisory service. It's more so for business owners, in that, hey, if I have more time with you throughout the year, there's more things that I can know of to plan for. There's more things I can anticipate for you. I can also estimate your taxes for you because we have better financials. We're able to review those things, and we have more consistent time together. That's always going to produce the best tax plan if we spend time together and I help you not only with the planning, but also the implementation of those plans. Because I can give you a plan, but your actual acting on that plan is on you at that point in time, and you may or may not do things correctly, right? So more time is always going to be the best.
For me and my tax strategist, right? For us, what we've determined was, just at a high level, our strategy for this year, which is something that I've talked to Ashish, my tax strategist, with, is at the beginning of this year is, hey, let's go buy X amount of real estate so that we can generate X amount of passive losses. So typically my goal for this year is to generate close to $200,000 of passive losses from my real estate business. So the question really becomes, how much real estate do we need to buy to generate those losses, right? Or what type of asset classes could I buy that could maybe help me pay less or generate that $200,000 of passive losses? Now, that's not a very specific plan. Obviously, my plan is a little bit more specific than that. But just for those of you guys watching, that's generally what I'm looking to do, is generate some passive losses, and then using real estate professional status, which my wife has, we're going to be able to use those passive losses against our active W-2 income and drop our taxable income by around $200,000. Generally, a very high level kind of sample plan that you might find yourself making when you work with a tax strategist. Now, obviously, there's a lot more specifics into that. I like to think of it as like a chess game, right? Because there's a lot of different things that you can be doing. So it's really like a strategy game in terms of position your assets, where should I place this cash? When should I do this? Because timing is also very important with tax strategy as well. Alongside me making these investments, every time I'm about to make these investment decisions, I always send an email out to Ashish or schedule 30 minutes on his calendar, and we talk for 30 minutes, and I just make sure I got all the timing and details down and make sure I understand it before I go take action on that asset. That's what it's like to work with a tax strategist. And the great part about that is that tax strategist, because you've been talking to him for the entire year, when it comes to tax prep time, it's so easy because he knows exactly what your strategy is. He knows exactly what your plan is. I've worked with a lot of tax prep people who have done a lot of things throughout the year that have tax implications. They didn't know about it. And then I come to them literally 3 months before tax time, and I'm like, can you file my taxes? They're like, we don't even know what you did. We don't even know what homes you bought. We don't know any of this stuff. So it makes it way more complicated, and then they get things wrong, and then you lose money on tax savings. So that's why it's really important to work with a tax strategist. Now let's move on to the next question so we can really get into the meat of this video, which is for W-2 high income earners. I really want to know, what are the most powerful options available to high W-2 income earners if they want to pay a substantial amount less in taxes?
I mean, you can always lose money on something that's going to help you reduce your taxes. You have to understand, the things that a W-2 earner has available to them are limited, obviously. Obviously, the first thing is always going to be, if you're not already maxing out the fringe benefits offered by your employer, which goes beyond a 401k, make sure you're maxing out your 401k, if anything, right? It's still deferring revenue at the end of the day. The second thing is make sure that any fringe benefits that are available to you, such as if they have FSA, medical reimbursement plans, HSAs, if they have, payment for education or dependent care, max those out as well. any fringe benefits that are made available to you, make sure that you're getting the max of those, because those are non-taxable dollars to you or pre-tax dollars that you're able to put aside. That is the first thing you need to do, is need to make sure you're taking what's available to you from your employer. A lot of times when you have high W-2 earners, is whenever I make a video, people are like, everyone that makes so much money has an LLC. No, I mean, not really. Not everyone has a business, things like that. But the fact is, you might have more business opportunity than other people, because if you're a high W-2 earner, you probably have a skill set that is marketable, right? You could probably market a skill set in some way. That's why a lot of people have like consulting and things like that. Sure, that's a legitimate business if you can actually go out and make some money. Now, there might be a way for maybe not necessarily losing money, but you might be able to offset some of the costs that you're already paying for. That's the ultimate thing. I know a lot of people look at I'm going to start a business so I can offset my W-2 income. A business should be started to earn a profit, right? I mean, you're going to earn a profit in this business, but ultimately, maybe in the first few years, you might lose money, but you got to look at it like this. Now, a portion of my cell phone bill, my home office expense, I'm going to be able to take maybe some of my car if I use my vehicle in my business. Maybe I buy a new laptop and things like that. That's mostly for my consulting business. I'm now able to take all these things as a W-2 earner. Can't do anything with, right? I have nothing. Now, at least some of it becomes pre-tax. These are sunk costs I was already going to pay for or already paying for, that now I'm able to deduct pre-tax while also making other money. That's pretty sweet. Still making extra money, right?
So an example of that is like for this YouTube channel that I'm starting, right?
Mm-hmm.
I'm able to deduct the cost of my laptop. I'm able to deduct the cost of some of my workspace. There's like the home office deduction that people talk about. And that could save me a couple of thousands of dollars. What I like to think, right? And correct me if I'm wrong, because the thing that I like to focus on is real estate, because from what I've seen, real estate is really the only mechanism that can really completely wipe out my tax bill. Because home office deduction, sure, maybe I get a $10,000 deduction. 401k, maybe I contribute, $20,000. Okay, well, I still have $350,000 more of income. It's not really putting a big dent in that 350. So
let me explain. I'm a realtor. I'm very biased. Broker's license
me too.
in real estate. Very, very biased. I think real estate is over 401k and IRA. If you have a chunk of money, I'd rather put it into a bunch of real estate assets. But my primary thing is not it's going to make me have less of a tax bill, because it may not, right? Because unless I'm constantly buying new properties, which maybe isn't an option all the time, or I'm buying properties that really aren't cost segregated, like they're too cheap. They have a good ROI, a good cap rate, good ROI. I'm able to buy this thing, but cost I can get makes no sense. And it's not really going to create much of a loss for me. The ultimate thing is this. Here's why real estate is a fantastic investment. And I think it's better than IRAs, 401ks, things like that. In terms of long-term investments, right? Is one, I'm buying an appreciating asset. So I'm going to buy this thing in 10 years. I might be able to leverage against it again, buy another asset and things like that, because it's appreciated in value. Well, at the same time, I have an asset that's at least cash flowing, right? At least in excess of the expenditures, the mortgage payment and the HOA fees, the repairs, maintenance, all this kind of stuff. In excess of that, I'm actually getting cash into my bank account. Let's say I'm getting $500 a month or something like that, right? Let's say you're getting $6,000 a year, but at tax time, because of depreciation, even just normal depreciation, it gets me down to $0, right? I have $0 of taxable income or negative taxable income on that thing. And at least that carries forward. And I have something that's bringing in cash while paying no taxes on that. At the same time, it's appreciating in value. And if I want, I can leverage against it later. I can 1031 into another property at another time, not pay taxes on that sale. And I still have something that is going to bring in a lot of cash flow for me. And eventually, the more I build up my portfolio, the more I build up my wealth, it allows me to step out of having to do this W-2 work and having to do a lot of the things that I was doing before. It does have the advantage in some years to certainly reduce your tax bill. If you can be a real estate professional, you're all the better. If you have a real estate professional status, if you're not investing in real estate, it's kind of silly to not invest in real estate. You have this huge opportunity in front of you to do so. It's a better investment. And if it produces losses, it's going to offset my other income. So it's a fantastic thing. But even still, even if you're not a real estate professional, let's say you are investing in real estate. Let's say it does create a loss. Well, if you have other passive income somewhere else, it's going to offset that other passive income. And even if it's just carrying forward year after year, let's say eventually, because after a certain amount of time, your mortgage interest decreases, and your depreciation goes down a little bit.
Oh man, there's so many things. It's the main thing is people only look at cash flow, and then they calculate the return on investment only in cash flow. And that's great if you can get 8%, but that's only like the tip of the iceberg. You're not seeing anything that's underneath the water, right? That iceberg is massive underneath the water, if that makes sense. You're only looking at what's above the water, but the thing that actually makes you wealthy is everything besides cash flow. It's like the tax benefits, it's the mortgage pay down. Mortgage pay down is so underrated. If you're buying a $900,000 home with a $600,000 loan balance, right? You're essentially making $600,000 over 30 years. That's $20,000 a year, effectively, if you hold the property for the whole 30 years, let's say, because obviously the interest is usually front loaded. That's a huge wealth builder, right? And so if you have 10 of these properties, you're making $600,000 times 10 over 30 years. Now, obviously, to get to 10, that's pretty tough, but it is exponential growth when you get to that point, when you do have multiple properties. And so that's kind of where below the water kind of iceberg, that's the stuff that I like talking about, right? Because the cash flow is, in my opinion, cash flow is great, but it's more of a way for me to secure that property in terms of being safe, because during recession, cash flow is really great because I can even lower my rents and still cash flow. Whereas some other people might not be able to, like, if they lower their rents, they're going to be negative every single month on their properties. And then they lose their job and then they go bankrupt, right? Because they can't afford to hold on to these properties because they're negatively cash flowing. So for me, cash flow is more of like a form of safety rather than my form of like profit. Like that's not how I see profit.
That's not profit.
And that's for me.
Yeah, no,
right.
I'm not saying that as profit. I'm just saying in terms of an investment, that is not the profit. I don't look at I look at them at their cap rate based on no leverage first, and then I look at the leverage cap rate. I'm just saying in terms of, I could put my money in the market, right? I can get an 8% return on money in the market, but I'm actually not receiving any of that money until I actually sell those things, or I'm getting dividends and things that are going to be taxable to me without actually receiving the cash, which sucks.
Yeah.
Whereas with real estate, I can actually receive cash without having a taxable consequence to me, while also appreciating the value of this asset.
Yeah, that's crazy. Like what you just said is like, people don't understand that, guys. Because I had 2 rental properties that brought in roughly $60,000 of rental income. I didn't pay any income tax on any of that 60,000, and on top of that, I had an additional $389,000 of losses. So I collected $60,000 worth of rental income tax free. Also, I had a bunch of losses from my real estate business that basically wiped out my entire taxable income. I paid like almost $0 in federal income tax last year. So that's the tax side of things, right? And so that's huge, right? Because it allows me to have that money today so that I can go reinvest it right now. I kind of wanted to move into a little bit of some of the topics here. So you mentioned real estate as being like a great tax vehicle, like to save money on taxes, right? So, but what about for W-2 employees? Because you mentioned a lot about passive income, and we're talking about active income, right? So maybe can you distinguish or like kind of give some like context as to like the difference between active income and passive income, because most of these people have never heard of this. And what's the general goal when it comes to buying real estate if you want to save money on your W-2 income?
So if all you have is active income, the only way that you will save money on your taxes via a rental is with a short-term rental property that you cost segregate. Because if I buy a rental property that I rent out normally, I have a 12-month lease on a rental, I'm going to file this on Schedule E in my tax return, and Schedule E is passive income. Passive income means it's not earned. I'm not doing something actively to earn this money. That's how the IRS looks at it, right? They say you're not actively involved in this business day to day to earn those dollars. Like as an accountant, each day I go into the office, I have a W-2, and then I also have other income from the business and things like that. Those are things I'm actively doing tax returns for people. I'm actually doing consultations, things like that. That's active income. I'm actually earning those dollars. Whereas my real estate, I could throw money into it and I have to check on it every now and again. It's passive, right? Interest, dividends, capital gains, passive income. These are all passive types of income. In other words, I'm not actually doing anything actively to earn those dollars. Even though you do some activity in real estate, that said, it is deemed passive. This is why real estate, it's not always going to be a tax deductible thing. Because unless you are a real estate professional, which I'll get into in a second, unless you are someone who is a real estate professional, you have a special rule where I can take passive losses from my passive income against my active income, any other income I have, really.
Yeah.
Whether that be W-2
what I like to say is that passive and active live in 2 completely different domains and they don't mix. So passive losses, trying to mix that with active income, that's like trying to mix oil and water, right? That's what I always say. And so what you're saying with real estate professional status and the short-term rental loophole, which is what you're talking about now, is effectively a way to mix oil and water. Is that correct? Or
yes,
maybe a bad analogy, but yeah.
Real estate professional for sure, right? Because With the real estate
Yes.
professional, I still have passive income or passive losses, but the IRS says, hey, you know what? You can take that because this is what you do to earn money. You are a real estate professional. So the things you're doing, investing in real estate, is actually a part of your active lifestyle, your active income. So as a real
Right.
estate professional, your investments in real estate, if they produce losses, it actually goes against your other income, just any of it, because
Right.
those are losses in your active trader business. Oh, shoot.
Yep. Okay, you got it. Yeah, we can continue from here. So you're talking about real estate professional status. Now, most people don't know what that is, and that's why a lot of my profile is about exposing this concept, which is super powerful. It's the reason why I was able to save $80,000 in federal income tax last year. Right? It's like
Mhm.
it's at the core of my strategy, right? And again, this is a strategy that I've come up with my tax strategist. Okay. So I didn't just come up with it by myself. We worked together to create this plan. But effectively, you're saying that if you have a rental property and you generate losses within that business, typically those losses are generated from a humongous deduction called bonus depreciation. Am I right?
Generally speaking,
Typically.
yeah. If you're getting a very
Yeah.
large deduction, yeah, it's from bonus. Yeah.
Right. And that's a passive loss. But passive losses, again, normally can't be mixed with active income. But that's exactly what real estate professional status lets you do. Right.
Mhm.
And it's pretty much the only concept that allows you to do that, unless you're using the short term rental. But the problem with real estate professional status is really hard to get. So maybe you can talk a little bit more about how you can become a real estate professional. If you can't qualify, then pretty much your only other option, if you want to use rental real estate to help you pay less taxes on your W-2 income, is the short term rental loophole. Right. And so
That's correct.
for
That's
what
correct.
I've seen, about like 95% of the people who talk to me cannot qualify as real estate professionals. So then I tell them, if you want to save money on taxes on your W-2, then go with the short-term rental loophole. Maybe you can talk a little bit more about the real estate professional status way, very briefly, because again, like I said, 95% of you guys are not going to qualify for this.
Long and short of it, a real estate professional is someone in the real estate professional industry, a realtor, someone in construction, someone that basically does trade of real estate. So I think there's like 11 different things
Yeah.
that qualify for it. If you're in that field and you're not a employee of a company that does it, you are a business more than 5% business owner who does that thing. You're in that field. And if you work 750 hours in that field and that's all you do, or that's over half your time, you're a real estate professional. It has to be over half your working hours spent on real estate to be considered a real estate professional. So, for instance, if I have a W-2 job that I work full time, I'm working 2,000 hours a year, right? 40 hours a week, about 2,000 hours a year. I would have to work 2,001 hours on real estate to be a real estate professional while also maintaining this W-2 job. I cannot,
Yeah.
I can do both, but I'd have to be working 80 hours a week. Your chance of defending that to the IRS is very slim, and they do audit this, and they typically deny it. So a big red flag for them is if you have a high W-2 and you're also claiming real estate professional status, it's gonna trigger some things
Yeah.
for them. They're going to want some more proof. Now,
Right.
a good way that you've gotten around this, and I recommend this to people, if you have a spouse, fantastic. What do? They don't do anything, or they work part-time doing some things, or they have their own little side gig and stuff like that. Awesome. If they go get their real estate license, they start doing real estate full-time or even part-time. Because remember, 750 hours is less than part-time. It's less than half of their time, half of their working week doing real estate activity. If your spouse can go become a real estate professional, so it's still more than half their working hours, they're doing real estate activity and at least 750, they are now a real estate professional. Put all of the real estate that you purchase into their name. It's under them. They're the one that's actively doing it. It doesn't necessarily be in their name, but it's their business, right? Whatever it is. The best thing you can do is put it in their name. They can be a real estate professional, and their real estate professional status makes that income reduce your other joint income. You can deduct it against your other joint income. Because
And
when
that's
you
exactly
file
what we
joint,
do. Yeah.
yep, because when you file jointly, you are jointly liable for each other's income, credits, taxes, everything, right? What benefits one spouse will benefit the other spouse. So the benefit of real estate professional for one spouse benefits the other spouse's
Right.
income in that
And
way.
so I like to say that this is like the Shaq and Kobe combo because it's like the best potential pair that you can make, right? Because especially what I see this used the most, like the most common scenario is when one person is like a doctor, makes like $500,000, and then the other spouse is like making like $100,000 at their job. And so if this person who's making $100,000 just quits their job and becomes a real estate professional, right? They could potentially, because you're not going to make $0 as a real estate professional. Maybe you do, but regardless, right? Even if you make half the income, if you make $50,000 as a real estate professional, but you buy real estate, you could potentially make more money at the end of the year when you factor in the tax savings that real estate professional allows you to claim. Granted that you have to buy enough real estate. It's not just get real estate professional status. You have to get real estate professional status and then buy real estate. And then there's one other key to it called material participation, but I'm not going to really go into that right now just because we're
You
already pretty far along into this video. But
I'll just do a quick aside. You will have
yeah,
material participation. If you're a real estate professional, you already have more hours than even the highest hours they claim you need to have for material participation. But that said, they're technically, if you read step 2 of material participation, it just says you work more than any other person on this activity. So it's not a high bar. The IRS doesn't usually audit material participation. They look at real estate professional status more so than anything. So you're fine.
yeah. The substantially, I like the substantially all test, but I'm kind of scared to use it because it's hard to prove that. But that's a discussion for another time, I guess. So let's talk about the short-term rental loophole because I have some people asking me here about the short-term rental loophole. And again, this applies to most of you guys, right? Especially if you're single and working a full W-2, there's no chance you're going to get real estate professional. But it's mostly, again, like I said, it's mostly used by couples where one person is a real estate professional and then the other person is not. Collectively, on your joint tax return, you can claim real estate professional and you guys both get the benefit because you're filing a joint tax return. So that is pretty much like the only most common thing that I've seen, or the most common like use of real estate professional status. So let's talk about the short-term rental loophole. How would that kind of work? The short-term rental loophole. I know you talked about it briefly, but
yeah. So obviously with a rental, again, Schedule E, that's where I put my rental. It's a normal 12-month rental that I'm renting out my home. A short-term rental is 7 days or less, right? On the beach, something like that. People are renting it out 3 to 5 days at a time, stuff like that. If I have an average of 7 days or less rental, which means that people rent my home on average 7 days or less during the year, I have now what's called not passive activity. I actually just have an active business, right? So short-term rental means I don't file on Schedule E anymore. I file on Schedule C on my personal tax return, right? Schedule C is where that's where sole proprietors put their business, contractors, 1099, all that kind of stuff goes on Schedule C. It's active income. And again, this goes to material participation, which is, again, not an extremely high bar to get up to. Basically, you're doing all of the work and your spouse's activity adds to that. With a short-term rental, I rent my house out less than 7 days. I'm not considered rental activity. I'm considered a business. So I put all my income. That would be all my rental income from that. Let's say it's $100,000 during the year. And then I have all my expenses for cleaning, for processing fees, for repairs and maintenance, for furniture, for all the stuff that goes into maintaining this property, right? Software, everything that might go into it. All those expenses get deducted from that business income, that rental income. And then you have depreciation. Depreciation's the other expense that goes on this form, just like it would on the Schedule E. If I cost segregate my property, I could probably take a very large deduction in that first year. And you did ask, so bonus depreciation. Bonus depreciation is a form of accelerated depreciation, which allows me in the first year of having an asset, take the majority of that depreciation. It used to be 100% from 2018 to 2022 is 100%. So let's say you bought a $500,000 property and 400,000 of it was depreciable, right? And I segregated it out, and I was able to take 200,000 of this was 5-year property and 15-year property. So both of those are eligible for bonus depreciation. So that means I could accelerate $200,000 of depreciation. Instead of taking them over 5 and 15 years, I took them in the first year. I bonused it out. In 2023, the maximum I can do is 80% of that, right? So it'd be $160,000. But I could take $160,000 depreciation deduction, boom, right there in the first year. And then I have the rest of it.
And that's crazy.
Basis.
That's the elephant in the room that I was talking about because, you mentioned a lot of the other deductions. Let's say you do have a short-term rental, you buy some furniture. Great. That's $10,000. You get a $10,000 deduction. Great. You have to pay for some software. Okay. That's like $1,000, let's say, but bonus depreciation is $160,000. It's 16 times bigger than that furniture cost. That depreciation, granted, it is only for the first year. That's going to be the biggest deduction in your business by far, right? Yeah. At least for that first year. And that's what's going to generate that loss, right?
And a really important thing to note, though, on that is with a short-term rental, I have active income, which means it's subject to self-employment tax. Which if you're a high income earner and it's all under you and things like that, you're going to at least have an extra 3% tax on this income going forward. Do you understand that? And when I bonus depreciate in that first year, that means I'm getting rid of a lot of that depreciation deduction, which essentially is a way for me to recover the cost of what I'm paying into this asset, right? If I put in $100,000 into this asset, depreciation helps me recover that cost over time. I'm going to have a lot less depreciation the next year because I got rid of a chunk of it in that first year. So it is important to know, great first year, leading that, I might have income the following years. I might have positive
Right.
income.
But you're going to save a couple tens of thousands of dollars by doing this, right? My strategy is like you go buy more real estate and then bonus depreciate it again, and you use the losses from that deal to pay off any additional income that you now have from this first property. Now, can you explain why that might be a little dangerous? Like basically using your tax savings to like, go buy more real estate.
Well, you do have to realize your tax savings are not always going to, it's like you had said before, you're only going to save up to the extent of your taxes. If I save $50,000 in taxes, cool, I have $50,000. That may not even be enough to get me to the next property. And it may also be that maybe that next year there is no property available. The market isn't great in my area for rentals right now. I'm in the Maryland area, the DC metro area. Great properties, great appreciation, way too expensive. Not good caps. Wouldn't recommend buying them. So you might go through a year or two where it's like, interest rates are a little too high. I can't even leverage this correctly. It's not really going to work out for me. I'm going to have income that next year, but it's okay. So you still have an appreciating asset. You still are making money. You're making money in excess of the tax. It's fine. It's always important to know beyond the strategy is that first year is great. It's important to know that means I got rid of a lot of my depreciation. So the next year I'm going to have less on that property unless I buy another way or unless I buy another asset in my business, something like that. It's going to produce income for me more than likely. And that's fine, but it's important to know. It's important to know all the sides of everything.
So again, my target audience is like high W income earners. These are typically people who are not living paycheck to paycheck. They're saving like $100,000 per year. And so if they do get a $50,000 tax savings, then their purchasing power for that year just increased from $100,000 to $150,000, which you could use to go buy maybe, I don't know, like $800,000, $700,000 worth of real estate, let's just say, right? So if you use the short-term rental loophole, you could potentially do this every single year if you are saving $100,000 every year, right? Because if you're saving $100,000 and saving $50,000 from the year prior, that's $150,000 of purchasing power every year. My strategy is you go buy a $700,000 property every year, right? Or it doesn't have to be 700,000. It really depends on how much cash you have. But one of the problems with that is bonus depreciation phasing out. So maybe you can talk a little bit more about what strategies I might be able to implement to still save a lot of money on taxes when bonus depreciation is at like 40% or 20%.
When bonus depreciation phases out, obviously it's going to impact a lot of the cost segregation need that people have in the future. That said, a lot of the times when people buy rental properties, let's say you're a real estate professional, the depreciation, generally speaking, will produce a loss for you. It's not going to produce a heavy loss. You can still do cost segregation, and it's still going to be beneficial because a 5-year depreciation is still accelerated. And a 15-year is still half the time the other property. So even without bonus depreciation, I'm still accelerating depreciation, which means in the first 5 years, I'm going to have a lot more deductions. It also means I'm going to spread out how many years I get losses from this property on paper. Not in reality, on paper, on my tax return, I'm going to have those losses. So even with bonus depreciation decreasing over time, it doesn't mean that you're necessarily it's out.
Right.
Yeah, you're just not going to get a very large deduction.
Right. So what I've been looking at is some alternative assets, not residential real estate, because I've only been buying residential real estate. And what I've seen is that in 2022, I bought, let's say, a $1 million home. You could probably claim for bonus depreciation, maybe $250,000 of bonus depreciation. And this is just an estimate. It varies differently depending on where you buy the property and how big the property is and how many things are in it. But generally speaking, it's about 25% of your purchase price, let's just say. But there are other asset classes. For example, campgrounds and RV parks, mobile home parks. For example, residential real estate would be $1 million. You can get $250,000 of bonus depreciation that year, depending on where bonus depreciation is at. With if it's 100%, great, you get the full $250,000 deduction. So let's just assume bonus depreciation is, let's say it's just at 100%. Are there other asset classes like campgrounds, RV parks, mobile home parks that can give you a better ratio in terms of purchase price to bonus depreciation? Like as in, like if I go buy a $1 million campground, can I claim more than $250,000 of bonus depreciation? And if so, why is that the case?
I guess I'd have to do research to see if there is a possibility of getting a lot of depreciation, because when you buy land, especially like land like that, it's mostly you're buying an asset that's not depreciable. It's only the improvements that are put into the land that might be depreciable, or if they have an office building. So truthfully, most of the value is in something that's not depreciable. But in terms of investments, storage units, campgrounds, or mobile homes, trailer parks, best investments you could possibly get. That's what most investors look for those. They look at them because they're generally speaking going to get a great investment, great return, very low maintenance. Because again, I bought land. You park things on it. It's very cheap in terms of maintenance, things like that. Those are great investments. Is it going to be something that's going to create a lot of losses for you? No, probably not. But it's definitely going to create money for you on a very passive activity. So if you're looking to
Interesting.
increase your asset base, those are definitely great. Again, I'd have to do research on to see
Yeah.
what types
No, I
of.
mean, I was on a podcast and some CPA, I think his handle is Learn Like a CPA, said he bought a $1 million campground and he claimed a $900,000 bonus depreciation deduction in year one.
It might be the
Basically citing
improvements.
that,
It
yeah,
might be the
he's
improvements in
basically
the ground.
saying, right, he's basically saying that he has a ton of improvements in the ground. Like it's obviously it's not just a plot of land because land doesn't depreciate, but he probably has like a bunch of concrete pads, a bunch of like outdoor showers and things like that would kind of be the land improvements, right?
Exactly. That's what I'm saying. Like I'd have to
Right.
research it more. I don't know the answer to that question, but
I
sure.
guess
I
it's a
guess
case by case basis. Yeah.
yeah. I was gonna say, generally speaking, it's not going to be a high depreciation thing because most of it's just built up on land where people can park their things.
Okay. Well, yeah, that was something that I wanted to look into. It's kind of like because for the same dollar that I spent, for example, if I bought a $1 million home and I only get a $250,000 deduction, I might be able to generate like let's say a $200,000 loss. But if I went and bought this $1 million campground that could claim a $900,000 bonus depreciation deduction in year one, I might be able to generate like an $800,000 loss. So my dollar goes further in terms of tax savings. Again, not to mention anything about the actual profit, like how well this asset performs, because it's not all just about tax benefit. It also needs to produce a good amount of cash flow and profit, right? For me, at least, I always want to make sure that whatever I'm buying, the asset is producing some cash flow, and I'm not just buying it just for tax reasons, right? I think a lot of CPAs always like to emphasize that is don't just buy assets just for the tax benefits. It kind of has to be a good investment first, and then like on the back end, you get all these good tax benefits from it. So, did you have anything to add to that?
No, I would totally agree. It's you should
Yeah.
buy something that's a good investment first. Secondarily, there might be tax benefits to it, but if it's a good investment, you should invest in it.
All right, so well, let's move into a little bit more of like the quicker questions now. Maybe just get some of your opinions on this. So, what's your stance on retirement accounts versus real estate? Because I'm pretty heavily biased towards real estate, but what's kind of your take? Because you mentioned maxing out your 401k. What's your stance on those?
Like I said earlier, I would definitely say if I could invest in real estate over a retirement account, I would choose the real estate. Again, I'm investing in something that can create income for me without creating a taxable consequence for me while I have it, and secondarily is appreciating in value over time. So I have something that's creating income for me currently, it's increasing in value over time, and it's an asset on which I can leverage against and get other assets with. Whereas a retirement account is going to be what it is. Or like your 401k, you're limited in how much you can get a loan out from your 401k. An IRA, sure, I can have a self-directed IRA and purchase other real estate inside of it. But again, I'm converting passive income, potentially no taxable income, into regular, ordinary income when I eventually pull that out. Having a passive activity like real estate, especially because as you continue to accumulate assets, so you get 10, 15, 20, 30 properties, I guess I don't really need the W-2 job anymore. And now this can be the thing that I'm doing. Maybe now I can become the real estate professional.
Well, the main problem I have with the 401ks is this. How do you generate passive income from a 401k before I'm 60?
Yeah,
Like you can't.
don't. Yeah.
Right. And so that's the thing is like my goal is to retire at 40. If I put money into this 401k, I'm getting no benefit until I'm 60. So it just doesn't really match up with my goal of retiring early because it's every dollar I spent there is giving me $0 of passive income. Whereas every dollar that I put into real estate, at least it's giving me some passive income.
Yeah.
Again, not just in the form of cash flow, but in the form of, everything that we talked about, right? Would you ever recommend someone to pull money out of 401k to buy real estate?
You mean
Because
like
I'm thinking about doing
tax?
it. Here's the thing. So from my understanding, and correct me if I'm wrong, like let's say I have $100,000 in a 401k. If I pull them out, that's 10% off the top penalty. And I'll eat that cost. And I'll take that $90,000, combine it with some of my own money. Let's just say, let's say I combine it with another $100,000 of my own money. Now I'm sitting on $190,000. I take that money and go buy, let's say, $800,000 property, take bonus depreciation on it, generate, let's just say, I don't know, let's say $100,000 passive loss. And then using real estate professional status, I am able to reduce my taxable income by $100,000. When I took money out of that 401k, that effectively increased my taxable income by $90,000. Is that correct?
It would increase it by 100,000. Yeah.
Okay, so it would increase by $100,000. But effectively, I've just used that money along with some of my own money to go buy an asset that effectively reduced it back down $100,000. So now I'm sitting even. Is that correct?
Yeah. I mean, you're saying basically my only consequence was the 10% penalty.
Right.
Yeah. You're right. That's a good idea. You could definitely strategize around it if you could find something that can offset it like that. Yeah, that's a good idea.
I've I've been thinking about doing that because, like I said, that $90,000, now that I've pulled it out of the 401k, it's generating me passive income today. That's kind of why I'm not sure if I should put money in a 401k, because if I know I want to be retiring at 40, I don't know if my money is best spent there. Now, for some reason, I'm not able to reduce my taxable income for that year. And, I'm in the 37% tax bracket. Maybe I'll just put money in the 401k because I'd rather just, not pay 37% on that income. Generally speaking, I like to definitely put more of my cash in the real estate just because, like I said, it can generate some passive income today. So that's something I've been thinking about. So that's good that I got that
Yeah,
verified
sure.
from a CPA. The one thing I wanted to mention, I don't know, I didn't have this in the show notes before, but the EV credit I asked you, I don't know if I asked you about it, but the EV credit, the federal EV credit, requires that you have an AGI of $300,000 or lower. My wife
Mhm.
and I are slightly above that number, right? So would it be possible for me to buy real estate this year, use the bonus depreciation, generate some losses, use real estate professional status to decrease our AGI below the threshold so that we can now qualify for the EV tax credit?
Yeah, so you have to understand this. Yes, sure. Depreciation is a business expense. The IRS doesn't usually do modified adjusted gross income adding back in certain business expenses. So yeah, for sure. Your losses from a business would reduce your income. In the same way, like if someone was right over the just on the precipice there, I'd be like, contribute to a 401k, contribute to an IRA, something to get your income down. Like, why? Well, you're going to
Right,
miss out on $7,500 because you
right,
couldn't spend 2,000. Do that for
right.
sure. Yeah. So yeah, if you create a loss in a business, because that's what you're doing, you have a real estate, you have
Yep,
rental real estate, you have a business, and it created a loss.
yep.
Regardless of how the loss happened, yes, it would reduce your income.
Yeah, so that's a crazy thing. So, that's kind of unlocked because we were like, we don't really want to buy an electric car, it's pretty expensive, but buying real estate and using the losses from that real estate business to essentially reduce our AGI from our W-2 can actually qualify us for that EV credit now. And that's a $7,500 tax saving. So now we're considering it again, right? But I think we don't actually qualify for the state program. What we're talking about here, guys, is federal income tax, right? This is federal law. Bonus depreciation is on a federal level, but I also have state income and state income tax. If you look at my state income tax return, my income on that tax return, it's still, 400,000 or whatever. It wasn't reduced at all by bonus depreciation because California doesn't actually recognize bonus depreciation. So on my
Right.
state income, what I reported to the state is that I actually made like the full amount. So I paid the full amount of taxes on state income. But for federal, my federal income tax or taxable income on the federal side was like close to zero for 2022. And so I would be able to qualify for the EV tax credit in federal, but I wouldn't be able to qualify for any state incentives. Is that correct?
That's right. Yeah. Maryland does the same thing. They decouple depreciation, meaning it doesn't
Right.
accept bonus depreciation. It only accepts a certain amount
Oh,
of one
interesting.
section 179 depreciation. Does not recognize it. You're correct. That is true.
Yeah.
Each state is different. Some states do, some states don't. So you'd have to check with your state to see where it falls in that realm and if it has an EV credit itself. But that's a good
Yeah.
point. That is where you're going to see it come back. But no, federally speaking, yeah, it's on an AGI adjustment.
Gotcha. Dude, that's super awesome. I mean, at the end of the day, it's really a game of being able to control your taxable income, right? Like that's kind of what it is, right? Because whatever you report as income, that's what you pay taxes on, right? And so 401k, putting money into 401k is a way to basically lower your AGI, like buying real estate and using
Mhm.
the real estate professional status or the short-term rental loophole to carry over some of those losses against your W-2 is a way to drop your AGI. And if that allows you to qualify for some federal tax incentives, then that's even better, right?
Yeah, for sure.
I guess to kind of close out, maybe you can share some of like your most helpful resources for people who want to learn more about any of the things that we talked about,
Yeah, that's a good question.
besides your
Resource.
YouTube and TikTok, of course.
Sure. I mean, you can always follow, yeah, my TikTok, my YouTube. I try and delve into what a lot of people think are like a lot of myths and things like that you see across the TikTok, social media, all those kind of places. I debunk a lot of those types of things. Absolutely, you can definitely follow me there. I try to answer a lot of people's questions as well as they ask them related to tax topics. That's a great resources for learning about maybe real estate professional status and things like that. I'm sure that there are some books out there. I do not know any of them because I've never needed to read them myself, so I apologize for that. Keeping up with taxes in general, if you want to keep up with how the taxes, the tax code, and things like that are moving, subscribe to some publications like Accounting Today, the Journal of Accountancy, and stuff like that. Those are really well-sourced publications that are going to have really good information for you. It's not a blog post. It's not going to be just some random person's opinion on something. These are generally going to be coming right down from the IRS, from the Internal Revenue Code, from the actual court cases. You'll actually learn good things in these. Subscribe to real tax websites and things like that. They can provide you some decent information. They give you a thing every day. You could ignore them most of the time, but sometimes there's going to be something in there that actually pertains to what you're interested in learning about. Those are definitely great things to do.
I think personally for me, I like to kind of just learn about the overarching concept and what the benefits are. And then all the details, that's what I rely on Ashish for, right? Because you guys are the professionals, right? But yeah, I mean, thank you so much for joining, man. Maybe we can close out by maybe kind of just plugging some of your social media if anyone wants to go ahead and follow him. What social media are you on?
So I'm on TikTok. I'm Nick the CPA on TikTok. I'm also on Instagram. I'm Crop the CPA. On YouTube, I'm also Nick the CPA. Someone stole Nick the CPA on Instagram, and I didn't feel like doing the little like underscore. I was like, you know what? I just want it to be a clean name. So Crop the CPA on Instagram, Nick the CPA on YouTube and TikTok. I don't have any other platforms at this point in time. I'm sure eventually I'll get there. If you follow me on,
and I'll leave.
if you follow me on like LinkedIn or something like that, I'll accept it, but I don't go on there. So
yeah, well, I'll leave all the links in the description for you guys if you guys want to work with Nick. But yeah, thank you so much for joining. And if you guys haven't already, you guys can go ahead, subscribe to Nick and my channel. Again, I mostly talk about the real estate professional status and short-term rental loophole, but there's a whole world of taxes out there. It's like, you know, it's a crazy world for sure. But yeah, and so far, guys, I'll just say, you know, I worked with Ashish, and I haven't worked with a tax strategist beforehand. I only worked with CPAs. I never saved any money on my taxes prior to working with a tax strategist because I always waited until the year ended and then I would go seek out a tax professional. Doing tax planning at the beginning of the year is the real game changer. You really want to save money on taxes because then you're generating a plan and then you execute on that plan. Whereas if you don't do that, you're kind of like a chicken with its head cut off, just running around, and then the year ends. And then
if I could add on to that, don't first think that you don't have the right person. Go ask them, can I do tax planning with you first? Don't leave them until you've had that conversation. If they don't do that, then go find someone that does it. A lot of times, accounts aren't necessarily going to be thinking that you need that thing because you've never asked for it. Go ask them. Right. Can we do tax planning? Can we do tax strategy? A lot of CPAs have the knowledge to be able to help you. Some don't get me wrong, but ask first. Don't think that they're maybe not providing it. Maybe they haven't figured that it was something that you need at that point in time. So it's always a good thing to ask your accountant. Can we do some tax strategy, some tax planning? Set up something. I'm sure that they would love to help you out.
Yeah, well, we'll leave it at that. And thank you guys for watching. I know it ran a little bit longer than I expected, but yeah, thank you guys. Like, comment, and subscribe. If you guys have any questions, I'll go ahead and reply to any comments you guys have. Thanks again for joining, Nick. Really appreciate it.
All right, man.